Good afternoon, everyone, and a very warm welcome to Farmers Weekly's webinar. I'm Suzie Horne, Farmers Weekly's business editor, growing up on farms in East and North Yorkshire, where my brothers are arable and sheep farmers. So thanks to everyone for joining the webinar and to our panel for their time and expertise. Tonight, we'll have 3 short presentations on how the sale and leaseback of farmland is changing, in that investors are looking to buy land with long-term development potential and then offering long-term tenancies to vendors who can then continue farming. The difference here is there's a share often in the agreement of the uplift in value once planning permission is achieved. So to introduce our panel, first we have Roland Bull, partner and head of rural investment at Bidwells. Roland oversees rural property investments worth about £1 billion for some of the UK's longest standing landowners and farmland investors. He works with 9 Oxbridge colleges, the Wellcome Trust and several landed families in the rural investment market, covering sales and purchases, lease arrangements and development activity. Sustainable markets, green infrastructure and natural capital markets will be a significant part of the UK's future green economy, and Roland's been delivering biodiversity gains during development for more than a decade. Then we're going to hear from Michelle Cookson, who's a partner at Mills and Reeve. She's a real estate partner there, and she specialises in strategic land development. She's advising large landowners, funds and promoters on landowner-led developments, including sale and leaseback, promotion and option agreements and other forms of joint venture. On the tax and finance side, we're going to be hearing from Andrew Robinson, who's a partner and head of agriculture at Armstrong Watson Accountants. Andrew's a farmer's son from a large hill farm in North Cumbria. He regularly still works on a friend's farm, and in his professional work, he concentrates on looking after and advising farming businesses and landed estates across the north of England and into the borders. So after we've heard from our panellists, we will open things up for a discussion and then put some of the advanced questions we've received and the questions that we received from you, the audience, during the session. There's some links to resources on your screen, including a case study if you want to download those. And audience members, please ask a question at any time. Just type them into the box at the foot of your screen, and then once the presentations are over, I'll direct them to the panel. The webinar is expected to last for about an hour and 15 minutes, and then afterwards it'll be available on demand. You'll get an email to let you know when the recording is ready for viewing. So if we go straight to our first speaker, Roland.
Thank you, Suzie. So my role is really to sort of give a brief introduction to the concept of sale and leasebacks and really the circumstances in which they're relevant at the moment. So lots of people will be familiar with the principle, particularly from the 70s and 80s, when there was lots of interest from institutional investors in agricultural sale and leaseback acquisitions, where the vendors at that point would have been re-granted leases under the Agricultural Holdings Act, and therefore benefited not only from lifetime security, but potentially from 2 further successions. So obviously where we're doing that now, any leaseback is very reliant on the contractual terms that are agreed with the purchaser. So as I say, the circumstances in which we're finding this is an attractive proposition for farmers, landowners that are looking to release some capital from their business is often for succession purposes. So if they want to pass value to the next generation in a more equitable way and release some capital from the farming business in order to facilitate that, possibly for business expansion. So either to release capital to invest, acquire new land. We've seen several where businesses have reinvested that to expand their farmed area, or for restructuring. So they make, partnership dissolutions again are an instance that we've come across where there is a need to release capital but a desire to carry on farming. And finally, the repayment of debt is relevant. Sorry, I don't know that. There's a terrible noise in the background. I don't know. Okay, Sorry. And the sort of properties that this applies to. Suzie mentioned development, and obviously that is one aspect that is of particular interest to the institutional investment market. But we have recently done sale and leasebacks on high quality agricultural properties. We bought several years ago an irrigated sand farm on the Pewsey Vale, actually from Vitacrest, where we regranted a 20-year leaseback on that business. So, you know, it's quite an interesting opportunity for landowners who are looking to release capital, but, you know, without stating the obvious, want to carry on occupying and farming that holding. The nature of the leasebacks that are often granted are such that it will minimise the immediate disturbance. So we've had instances where we've bought farms and the incumbent then tenant, you know, hasn't even then necessarily informed neighbours. So, you know, there's very little change in terms of the day-to-day operation, but they've been able to release that big chunk of capital. Where development interest is, you know, part of that deal, again, they've been able to retain a significant interest often in that long-term development value. So we will typically have a leaseback with a development agreement that sits alongside that, that compels the purchaser to actively pursue the development, and then share that value with the seller once it's realised. So one of the real benefits of the long-term institutional investors is that they do have the flexibility to accommodate funding requirements, and quite often what we see is you know, complex family situations where there are multiple ownerships and some very specific requirements in terms of the ongoing occupation and also the nature of the sale itself. Could you just put the next slide up, please? So this is a sort of hypothetical example. There are some parallels with a real life example that Michelle's actually been involved with here. But this sort of sets out the broad structure that a seller might expect under a sale and leaseback. So this particular one is 650 acres of irrigated mixed cropping land within a family partnership, multiple ownership sitting underneath that. So quite a complex purchase structure. Some restrictions, overage on part, but with medium to long-term development potential. So this won't typically be relevant where there is very short-term development value. In this case, as is often possible, the investor paid a premium. They paid full hope value for the land with development potential, and there was no discount applied to the remaining land and buildings because of the leaseback. So the valuation impact of that long lease that was granted back to the vendor was not actually recognised in the purchase price that was paid. So say in this instance, it's 30-year leaseback on full repairing terms. So really the intention being to set it up in a way that the purchaser and then landlord's sort of intervention in day-to-day running of the holding was minimised. So the incumbent could just carry on effectively as they had been, with, as I say, little intervention from their new landlord as possible. The rent was fixed as a function of the initial investment value, the acquisition cost, but with a mechanism to allow that to be rebased on the loss of BPS. The rent was set at a level that was well below what the equivalent cost of debt would have been if the vendor was simply taking additional debt against the property. They benefited from a preemption both on a component of the residential element, but also in the event that the institutional investor sold part or all of the land for any reason other than for development. And again, say that there was an agreement that sat alongside the tenancy, which does compel the institutional purchaser to actively promote that land with strong collaboration and input from the seller, and then ultimately share the gains that are realised from that development once it's realised. So I think we'll probably come back to this case study when we get some questions, because it gives a good example that we're able to talk to in terms of some of the tax implications and other factors.
Right, that's great. Thanks very much, Roland. I take it that's the end of your presentation. There was just a bit of interference there. Yeah. Okay, so we'll go to Michelle now. Thank you.
Thanks, Susie. So following on from really what Roland has said, I just wanted to really set back, and if you can take the next slide, please. So we talked about sale and lease back, so I thought it would just be helpful to spend a little bit of time saying, what do we mean by sale and lease back? What are the documents that would be involved, some pros and cons, and then just to contrast other forms of landowner development, because I think those have been covered in an earlier session, but just to contrast that with what we're talking about today. So next slide, please. Thank you. So as Roland was saying, what we're talking about here is, and this is a big difference, as we'll see, to some of the other arrangements that you might have, an option or promotion agreement. On day one, the key benefit to this type of arrangement is that as a landowner, you would receive the existing use value of the land with a premium on the basis that there is vacant possession, albeit on day one, a new farm business tenancy would be granted to allow you to continue in occupation. So the buyer would take on promotion obligations, and it's a matter of negotiation how extensive those are, but broadly speaking, the promoter, buyer, your partner in this arrangement, would be required to promote the land through planning. It's important to choose your partner carefully, because you're going to be reliant on them to deliver the planning permission and the increased value. You'll hear sometimes people talk about patient capital, and what we're looking at there is where this is a longer term arrangement. It might be that planning permission isn't going to be obtained for quite some years, so important to have somebody who's going to be there working alongside you during that time. I'll touch a little bit later on preemption rights. All that means is it's a right of first refusal. So if the buyer decides that they want to sell any of the land without planning permission, then they would come to you first and give you the right to buy it back. It might be the farmhouse, it might be cottages, it might be some of the land that hasn't actually got planning permission. And then ultimately, the benefit is once planning permission is obtained, then you will get a share in the uplift in value over and above the existing use value that's already been paid. So legal documents, everybody loves a legal document. Lots of them in this type of arrangement, but just briefly so that you understand. Sale contract and transfer, because what we're saying is on day one, the land is sold, it's transferred to the purchaser, you've been paid the purchase price, and ownership moves across. But as Roland said, actually, to all intents and purposes, you would continue farming under a new farm business tenancy, paying a market rent. The length of the term would depend on negotiation. I've seen them typically 30 years, but could be less. And that arrangement, obviously, once planning permission is obtained, then the tenancy would come to an end in respect of any land being disposed of, so that it can be sold. Preemption agreements with the other sort of agreement that would sit alongside it. As I mentioned earlier, it's just a right of first refusal, which could be limited to particular parts of the property. Next slide, please. So the landowners agreement. So really, this is the key document, which is it sort of governs the ongoing relationship between the parties. So it will include the planning obligations, It will include a development period, which could be 10, 20, 30, or even I've seen up to 80 years long. It will provide for all sorts of things, so that the buyer or the promoter that you're going into the relationship with may provide that if they need to acquire third-party interests for access or infrastructure or any other purpose, they can do that. Before it goes to market, it's sometimes worth putting in some key infrastructure because that would increase the value. And then it will provide for the share of what we call the net sale receipts once planning has been obtained. And there'll be a list of deductions that you'd need to agree. These I've listed some there. So acquisition costs. So they would say, sell the land, say for 100 million. That would be nice. You take off the original costs of purchase, the planning promotion costs, any infrastructure costs they've incurred, any third-party interest that they've had to buy, sometimes a return on the initial investment, which would be if the land had been acquired or costs incurred over a period of years, then the buyer may well want a percentage return on those costs, and then you deduct the final cost of sale. Pros and cons. As I mentioned at the beginning, the big pro for this sort of arrangement is actually that on day one, you would have the existing use value with a premium released, which could then be reinvested in the farm, in machinery, or for any other purpose. Sometimes used as an opportunity to restructure farming interests. We've seen it quite often to the next generation, or a farming company will be set up. Continuing occupation, continue farming. With the right partner, you're staying on site, you're involved and able to work together on this future promotion. But it's the partner that takes the planning risk. There is no risk to you as landowner. And you get a share in the net receipts once planning permission has been obtained. What are the cons? Well, it's not suitable in every case because you need to have a partner who's willing to invest in the agricultural value. Quite often it's larger, more complex sites. And sometimes, Roland can talk to this better, but there may be a lower return than if you entered into a straightforward promotion agreement. But I think we'll come back to that in the context of the case study. Just a brief word then to contrast the other forms of landowner-led development. Sometimes you might have a conditional sale, so somebody wants to buy the land, but there may be conditions, which may be around planning, or it may be they want to do some archaeology tests or some environmental investigations. Once those results are in, once planning is obtained, then that sale will have to go through. And that would typically suit a house builder or developer who's pretty sure of getting planning, but just wants to do some more tests before they complete the purchase. Promotion option agreements. Again, the risk sits with the house builder or the promoter. You may well get an option fee up front, which is your return for securing the land or giving the land to the promoter for a period of time. Maybe 5 years, there may be an opportunity for them to pay an additional fee to extend that if they still haven't got planning permission. Once planning permission is obtained, then if the land is sold, then the promoter would take a discount from that, and the rest of the purchase price would belong to you as landowner. And the sorts of deductions you typically see are a 15% deduction, which would go to the promoter, reimburse all their costs, and then the remainder would go to the landowner. So in summary, these are quite complex arrangements, and I would say it's important to get proper advice, because the institutional partner or promoter that you're going to be working with will have got, they're likely to be properly advised, and you want to make sure that your interests are protected, and that you get a good a good deal for you. I think which agreement is right for you depends partly on the location, the likelihood of planning permission being obtained, over what kind of period will inform the type of agreement. The higher the risk the promoter takes, then the bigger the return that they will expect. Think about alignment. Are your interests the same as the promoter? If you're both trying to sell the land, then you've both got a shared interest in getting planning permission. Important to think about what you want to get out of it. Do you need cash up front? Is it helpful? Because then you may get a lower return in the future. If you can wait for the return, then that may be more beneficial. But I think if we can return to some case studies and then talk those points through with you.
Thank you very much, Michelle. So we'll go straight on to Andrew now and hear what he's got to advise on tax and finance aspects of these type of arrangements.
Thanks, Susie. I thought I would just go through some of the sort of headlines across the various taxes. I think it's fair to say that every business, farming family or farming partnership has a different set of tax circumstances, and everyone's details different. But
we can't hear you, Andrew. You're muted.
Sorry, I clicked the button twice.
Okay.
Technology. Apologies for that. Yeah, I'm just going to run through some of the sort of headlines of each tax that would be involved in a sale and lease back. I think I'll just put a caveat on that everyone's situation is different, their business structure is different, so that has an impact on how the tax would work for them. But if we just look at a fairly standard sale and lease back, obviously the first thing is that the current farming business is usually a partnership or company and will be paying income tax or corporation tax on its proceeds, on its profits every year. So once a sale and leaseback is done, any farming business that remains or that continues to farm the land will have a rent going through its accounts payable on the FBT terms, which will be tax deductible. So that does have an impact on that tax, but that's really just something to bear in mind. Probably the most relevant tax in these sort of situations is the capital gains that would be payable on the sale and leaseback transaction. Currently, the capital gains tax is paid on a number of different rates. Farmland and buildings would usually be 20% or 10% if business asset disposal relief can be obtained, and I'll come back to that. And sometimes these sale and leasebacks would involve buying farm land and property which may have some residentials included in the sale. Now, residential properties are at 18 and 28%, and I think it's also worth bearing in mind that if a residential property is sold as in part of one of these transactions, that tax is actually payable 60 days after the transaction. But if we just concentrate on the land and property and presume there isn't any residentials now, obviously there would be a sale on an agreed date. So the landowners would sell the land to the partner in the sale and leaseback and would have a capital gain to declare on the proceeds and capital gains tax to calculate. As with every gain, that would be on its capital gains base cost, which might have been a purchase price or might be a historic base cost from when they inherited it, and the proceeds they're going to get. If no careful planning is done, that gain will be payable at 20%. We all hear an awful lot about entrepreneurs relief, or as it's now called business asset disposal relief, which can reduce the gain to 10% on £1 million per individual. And I think the critical bit in here is if a farm partnership or a farmer or a farm was farming the land prior to the sale and leaseback, that business that was farming would have to cease and stop farming, because the rules around business asset disposal relief very much focus on the sale of whole or substantial part of a business. And if that business was to continue trading on the same land in the same entity, you would lose your right to the 10% business asset disposal relief. So I think there's some interesting planning to do there. Obviously, many of these deals have what can be often called, and the terminology is probably better from somebody like Roland or somebody, but overage in them. So you get another lump of proceeds if when planning is obtained and the development value goes up. Again, they will be subject to capital gains when they're received at some point in the future. And I think just another point to note, and it'll probably, I think, come up in one of the questions or case studies, that if you enter into an agreement where your future proceeds are dependent on property sales on that land, so much a house or something, and I know my colleagues on this call can say it better, then there's a risk you enter into, for tax purposes, a slice of the action deal, where rather than paying capital gains on all the future proceeds, you would pay income tax on some of them. And as we all know, income tax very quickly becomes 40 or 45% once there's a significant sum involved. So there's quite a lot of thought to be entered into before you go for those slice of the action, because it will potentially cost you more tax. I suppose the tax none of us want to think about, but will happen to us all someday, is inheritance tax. And in most cases, the shares in a company farming land or farm itself, when it's been farmed in hand, will qualify for either 100% agricultural property relief or 100% business property relief. But so as the farming entity sits at the moment, before they sell the land, they've got an investment worth hopefully many millions, which would be covered by agricultural property relief. They then go ahead and sell it and turn that into liquid funds, cash, money, and in the very simplest form, put that in the bank. They then have an asset for inheritance tax purposes as no relief. So, and if somebody sadly passes through somebody's estate, there could be a significant inheritance tax charge on those funds gained from the sale. So there's obviously some planning to do after the funds have been received. It also depends massively what the funds are used for. If they pay off debt, they've gone to another thing. If they're invested into other businesses or gifted away as part of succession planning to other family members, they're all to take into account. But it's just something, agricultural land is a very safe and inheritance tax-free asset if farmed in the correct manner. Also, I think we could probably there's a strong risk that the overage payment that may or may not be received in the future, does it have a value and does it qualify for any IHT exemptions? Something also there. And I think it's worth just mentioning two taxes that can be in danger of getting forgotten about in these sorts of deals. Obviously, one of those is VAT. Now, it's pretty unusual that VAT would have to be charged on the sale of the farm on the sale and lease back, at least initially, unless there's an option to tax in place. However, the VAT on the professional fees in arranging and making the sale will only be recoverable if they're recoverable under the partial exemption rules, because they relate to an exempt supply, the sale of land. So I think, my forte isn't VAT. That's one of my colleagues at Armstrong watching things, but there's just something to be wary of there. VAT's often a forgotten tax. And then finally, The other one I thought was just worth mentioning was stamp duty land tax. Obviously, we all sit here and think, well, that's the purchasers, your partner in this type of transactions problem. They'll pay the stamp duty land tax on the purchase price. Just do remember that, obviously, if you enter into a FBT, for example, of 30 years, there is a net present value calculation to do on that value of that lease, and stamp duty to pay by the tenant on that net present value. Now, it doesn't add up into hundreds of thousands, but it can quickly get over 10,000, that stamp duty. So again, it's not, I'm sure it wouldn't be a deal breaker, but it's just little things to remember there on the tax front. So hopefully that's given people a quick whiz through of some of the headlines. As I say, every situation is different, and we'll no doubt come across some of them in the questions.
That's great, thanks, Andrew. So lots of food for thought from all of our panelists, and I think we'll go straight to questions. We've just had a general one on what are the benefits of a sale and leaseback agreement for both parties. Obviously, the panelists have covered that area. But I mean, in terms of your experience, Michelle and Roland, in either on behalf of investors or where you've acted for landowners that might look at one of these deals, where that's coming from. What would you say for a farming family? Obviously, it allows the farm to continue and possibly pay off debt or come to some family arrangement. What would be the main reasons that you've found that farmers have taken on a sale and leaseback arrangement?
I think some of the less obvious ones are just simply having a well-resourced institution working alongside them. So it may be even access to more immediate investment. So we have actually done sale and leasebacks where, as part of that deal, there was an immediate commitment on the part of the institution to invest in new agricultural infrastructure, new buildings that could then be sublet on the holding to unlock some shorter term value. So that's one of the keys. I think the other thing which most of the vendors, now tenants, that we've dealt with where there's development interest, where they would just sort of universally say there's been a huge benefit, is actually just having a very well-resourced and knowledgeable institution pursuing the development interest. So, it's something that typically those institutions are very familiar with, that they are used to taking land through that process. Often they've got strong reputations to uphold, and they are, as I say, very well practiced at maximising the value of those sort of land holdings, possibly in some instances in a way that you're able to align interests in a way that you can't necessarily with a promoter who perhaps wants to flip something more quickly to get their return on their speculative planning expenditure, whereas, I say, a long-term institution really is better able to maximise value over the very long term.
Okay, thank you. Michelle, have you got anything to add on that front?
No, I think that's right, is it? And if you've got the institution who would take the long view, as you say, invest in the farm, work alongside you, build relationships with the local, perhaps the parish council, as well as the borough council or the city council. And actually, in many occasions, we found that the landowners themselves have some really valuable connections, and so really it does become quite a partnership if they're keen to stay involved.
Yeah. Thank you. And do you find that the investors put any? I mean, is it a very straightforward FBT usual terms, or do they tend to want to dictate, if you like, to put it probably a bit too strongly, how the land is farmed in future? Any sort of policies that they would want to impose on the tenant?
No, not at all. The only, if you call it unusual provision, would be to allow for the tenancy to be terminated once planning was obtained.
Mm.
But other than that, no, just perfectly straightforward, just to continue farming just as it was before.
Yeah. Okay.
I think that's often one of the sort of main objectives is actually to minimise, the impact of that change of ownership really on the occupier. So, and one of the attractions equally to an institutional investor can be identifying a high quality, operator partner that will continue to be a good custodian of that asset. So, the hope is often that they will continue to look after it as though it is their own anyway, until such time as you can extract some higher value potentially from development. And that's absolutely the experience we've seen on many of the sale and leasebacks we've done.
Thank you. So we'll go to our next question. Yes, again, very straightforward one, and you covered it to some extent because I think your case study was 30 years, but Michelle mentioned that you've seen agreements up to 80 years. So what would be the typical sale and leaseback with this, where there is a development, long-term development potential?
Shall I take that? I mean, I think typically probably 30 or 40 years for the tenancy, but very often the development agreement, or what we're describing as overage provisions, which are rather sort of deferred payments and under the deferred purchase payments can extend much beyond that if the development prospects are very, very long term. So the seller may want to ensure that they still benefit from any uplift in value that takes place after their occupation ceases. But again, it's very much down to this, the particular circumstances. So if a seller is looking to provide for another generation, the tenancy hopefully could be tailored around the specific family requirements. Yeah.
Okay. Thank you. And another one, again, you touched on this because Michelle said in her presentation about full vacant possession value, sometimes even with a premium, I think you said. We've just got a question, what percentage of vacant possession is on offer for sale and leaseback? I mean, in these long-term development agreements, is it always vacant, at least vacant possession value?
So that's really the incentive for the seller is, so from an institutional investor's perspective, they would in any event be buying, even if they bought vacant, they would then be looking for a tenant occupier to take that on and pay them a rent. So there is less incentive actually to buy something vacant. And as I say, if you've got a high quality operator there that's going to look after the farm and hopefully work with you to realise that development potential, there really is no rationale necessarily to discount it. So typically what we will see is a minimum of full vacant value with an additional premium payable where there is some recognised hope of long-term development. But again, that will obviously depend on the nature of the interest that the seller retains in terms of the long-term development value.
Yeah, Suzie, just worth adding, I think one of the points that Andrew mentioned was about the slice of the action, which we're always keen to avoid. And I think here what we're talking about, we would structure it so that it's additional, it's part of the purchase price, it's almost a deferred payment so that it will be capital gains rather than income tax.
So you're effectively pulling forward some of that planning bonus, if you like, back into the purchase price.
Absolutely. And I think also the other thing is that if it's quite a large site, then in order to get the best value, I think Roland would say you wouldn't put it all on the market at the same time, or if you did, then you'd likely be receiving deferred payments, because if you said to a purchaser, I want all of this money up front, they'd have to borrow it, so you'd get less. So you might say, well, either we'll bring the site to market in parcels over a period of time, slow release of money coming through, or if the whole lot is sold, then there might be deferred payments over a period of, say, 5 years, which ultimately would allow for a higher price to be paid for the land.
Yeah, I see. And would there be any sort of tax query on deferring payments in that way?
I think no is the simple answer, because if it's a contractual sale with deferred payments, you actually pay all your tax on the full amount, including the deferred payments at day, or in the relevant first tax year.
All right.
So if you were going to get 2 million followed by another £1 million for 3 years, a total of 5 million, you would pay your capital gains on the 5 million in day one, or year one.
Okay.
Even though you haven't had it, which has some advantages if you're claiming business asset disposal relief, but it does need remembering you're going to have the cash flow implication of paying the tax on the full amount before you've had it.
That's right. You'd have to make sure that that initial payment is large enough to cover all of the tax that was due. Yeah,
absolutely correct. Yeah.
Thank you. Okay, we'll go to our next question, which Roland touched on to some extent, but just could you just sort of outline, Roland, what is a suitable site for this sort of arrangement? You know, what's the ideal from the point of view of the investors that you've been working with who are looking for long-term development land?
Yeah, so I mean, it really is, you know, what is attractive to an investor? Where can an investor justify paying at least vacant value, if not a premium over vacant value, whilst granting that lease back? So, as I say, there's obviously, you know, significant interest in sites where there is long-term development value or development potential. So, you know, areas of high development pressure, you know, high levels of economic activity. So where the terminal development values are higher, there will obviously again be, you know, be greater interest from the institutional market. I mentioned it's not just about development, high quality agriculture, and we've certainly, you know, we've got several institutional clients, you know, pension funds and the like, that are investing in high quality agriculture and are very happy to buy sites with no development potential at all, purely for their agricultural value. I think it's actually something that we may see more of. I do a lot of work in the environmental space, been acting for several conservation NGOs, delivering biodiversity net gain and large habitat creation schemes associated with big developments. And again, I see you know, some significant potential for sale and leasebacks in that context, where the seller is able to continue delivering some of the physical management of those sites. So there's, yeah, I mean, actually alongside sale and leasebacks, and it's slightly different principles than those which we've discussed, because typically what we're talking about here are private sales. You know, these won't be, you know, openly marketed. No, the seller may talk to one or more potential purchasers and decide which they want to run with, but you know, the terms will typically be very complex and, as I say, negotiated privately. Sometimes what we have seen as well is actually vendors marketing a property for sale, for the freehold for sale, but with, let's say, either a lease or potentially a contract back to the seller, so reserving the right to carry on contract farming for a defined period of time. And again, that might be an attractive proposition, you know, for some individuals, and potentially more relevant to sites where there isn't that long-term development potential, and where the purchaser is more likely to be a private individual, possibly looking to shelter inheritance tax, for example, rather than an institution, you know, which is more likely to be interested in the investment returns, as I say, from something like development.
Thank you. Okay, so we'll go to our next question. Yes, it's been mentioned about the importance of finding the right partner. What sort of institutions are in this market? I mean, I mentioned some of the ones that you worked for in the introduction, Roland, but is it a big range or a fairly narrow set of investors?
Many of our institutional clients will be interested in this sort of deal structure and the right types of property, and they include Oxbridge colleges, big charities like the Wellcome Trust we act for, several church boards, pension funds. So it is a whole range of institutions that you know, have capital to invest. And in terms of scale requirements, you know, we act for institutions that would look at purchases as small as 1 million up to, you know, potentially 100 million plus for the right sort of properties.
Okay, thanks. And so if somebody is interested in actually taking this forward, what would be their first step? It might go to all of you on this one, but Roland, you've got the floor at the moment.
Sorry, I think I'm hogging it. I'll probably let someone else do this. So, as Michelle said, it's obviously very important that they are represented. You know, it's the sort of thing that they probably could quite quickly, with the right advice, identify a small number of very high quality, credible institutions. It's not the sort of thing that necessarily they're going to get huge benefit from speaking to you know, dozens of potential partners, but as I say, with the right advice, I'm sure they could you know, come up with as I say, a much shorter list of potential partners that would be interested, and then start engaging around you know, what sort of terms might be available to them for that sort of deal. But again, the further they can go in determining what their own personal requirements are, length of lease that they'd be seeking, you know, tax structuring that you know, the institutional purchaser can accommodate, you know, all of those sort of things, you know, what their personal family requirements might be, you know, that will be time well spent, you know, thinking about that and defining that before they started actually engaging on any negotiation.
Okay, thank you. Michelle, have you got anything to add on that front?
No, I don't think so. I think part of the thing to think about is just in terms of where your farm is, and just to be aware of what's going on with the planning, because there'll very often be a local plan consultation. So get yourself tuned in. It's all online now. So I think if you are aware of the planning position, very often you'll find that as local plans get published in draft, the promoters, house builders, everybody else comes knocking on doors when they see sites that might be available for the current plan. So if somebody comes knocking, for goodness sake, take proper advice before you sign anything. But I think what we're talking about with this kind of arrangement is a little bit more long term. So I think these are sites that are not in the local plan, but they are perhaps next to or on the edge of a town or city that could be due for expansion. And I think if you bring in the right partner, then they will promote that for you. They will know who to talk to and bring their sort of expertise and their resources along with you. So I think, you know, if you've got agents that you normally use or lawyers that you've normally used, talk to them first of all. If it's outside their sphere of expertise, they'll be able to, you know, refer you to others who do more of this. It's quite specialist work. Or talk to any of us, and we can, you know, help if we can.
Thank you, Andrew. Just to you on this one, in terms of, you know, what do I do now? Are there any sort of tax and finance angles that you think would need tidying up before somebody sets off on this path? I know it's big problem sometimes with assets being, you know, some things are partnership assets, some are private assets. It's not always clear who owns what. So.
Yeah, I think I agree with Roland and Michelle that it's about take advice early. I think that's a good expression, a tidy up process. So understand who owns what already, whose name it's in, what any tax position might be. Where do you want the funds? What are you going to potentially use the funds for? Where do you want them to end up? You know, that might alter who owns the assets beforehand, and get that sort of thing structured. I think it's about getting your advisors team all in the same. If you're serious and it looks like something you want to pursue, it's get the advisor team all in the same room and sort of starting where we're at now, where you would like to get to, so you get a joined up team effort. But yeah, you know, it's about getting the ducks in a row before you start for the tax purposes rather than after, because it's committed then.
And I can imagine that, you know, all of this would take, the actual sale process could take quite a long time, or the negotiation and then the legal ins and outs. In terms of rollover relief, if you were going to reinvest and it can go into a trade, quite often another farm from a farmer's point of view, you've got up to 3 years to reinvest. But could you do, I'm thinking somebody might want to approach this with another farm in mind that they might want to reinvest the proceeds in, and you could potentially tie it all together if you've got long enough to organise the whole process.
Yeah, you could. I think the critical point there is you have your 3 years from the point of completion or contractual to do your rollover. I have seen cases where you can actually get rollover for longer than that, but you have to demonstrate very strongly that you're trying to reinvest the money into qualifying assets. I think Roland and Michelle could probably comment. I think any deals we've been involved with of this type, it's usually enough to focus on getting the land sold and the sale and leaseback sorted, and sort of almost worry about the next deal after that, or it can become, you can tie yourself in knots almost. But that's my view.
Okay, thank you.
Can I just say, I mean, I think everyone always assumes these things have to take ages. That's absolutely not the case. If you've got a very decisive institution, and we certainly act for several, who are able to make big decisions, with very big numbers involved very, very quickly. And if they're supported by very efficient and competent, particularly legal advisors like Michelle, then obviously they can conclude those transactions swiftly. And that is a really important factor, particularly where circumstances demand. And again, it does come back to that selection of a partner. It will be one of the criteria by which a potential seller should be judging their future partner as to how decisive they are and how quickly they can make those sort of things happen.
Okay, thank you. So could you say typically, not the very quick ones you just mentioned, but typically how long would this process take from either an approach from a landowner and they might be interested, or an approach to the landowner from an investor to that completion?
I mean, to me, I guess it would depend whether it needs to happen quickly. And if there was an absolute requirement for it to happen quickly, it could be done in as little as 2 or 3 months, quite easily. But we've all known these things drag on for much longer periods. So as I say, I guess it largely depends on the imperative to conclude it quickly.
Thank you.
I think I was going to say, just to add there, the sorts of things that have held it up is there might be one member of the family owns part of the farm. There always seems to be somebody that nobody's speaking to, that you've got to then have different negotiations, or you need rights across their land, or so sorting out the practical aspects, or not being able to find all the deeds. And I think Roland mentioned in an early slide about historic overage. So we found quite often that there might be a couple of fields that when they were acquired, overage was agreed to a third party uninvolved with this. So it's trying to, and that may be horrendous terms. So we've got to come to terms with that. Other things we've not touched on, obviously things like there might be problems if they've had environmental issues on the site, or archaeology, or we bought land which has been in sort of former mining areas, and there might be covenants on the land. We've had some which have been quite complicated. So look at your title, make sure that everything is in order, it's registered if possible. If there's any quirks, then try and get them sorted out now, because it's a really good time to do it. We can certainly help with all of that. It just adds to the time. That's all.
Okay, thank you.
Michelle may not thank me for saying this, but one of the things, actually, you don't need to have concluded every aspect of it for cash to be released. So if the institution and their advisors are able to take a pragmatic view on some things, quite often you can get far enough to be able to release some quite large sums of cash without, as I say, every aspect being completely finished.
Okay, thank you. We've got a question which may have partly been covered, but I'll read it and let the experts decide. There's a tax drag associated with legacy development. Is this perception and manageable, or a real drag? Sorry, I'm slightly confused by that. Tax drag, is that a term that people are familiar with?
It's not a term. My sort of interpretation of what you've just said is really around probably the overage, that there's you know, when planning goes through and you receive another lump of money as per the contract, there will be further tax to pay on that. And as we've said, if you avoid the slice of the action type deal, that'll be capital gains tax, at whatever rate and rules are applicable at that time. So it isn't a perception. There is a tax drag. I think it's just a tax charge. You hope, you know, you're only going to pay the tax if you've got some more proceeds. Is it manageable? Yes, you can look to do some, you know, you can manage, or should know what it will be, and you can use the rules that are there available. But I think, yeah, I don't know whether I would call it a drag. There's tax consideration and tax to pay if overage is paid.
Yeah, okay, thank you. And while we've got you in the chair, Andrew, you mentioned about the business having to, in order to get business asset disposal relief and reduce the capital gains tax to 10%, hopefully, that the business has to cease. But we're talking here about a sale and a leaseback. So could that literally be a partnership ceasing and then a sole trader or another partnership? How does that work? Or is it a generational thing where you could set up a new business under the next generation?
Yes, let's just look at that one. I was going to say yes and no. If it was a sole trader, which is you both say a sole trader, or a partnership that was farming the land and they sold the land, all those partners would not be able to, they would have to cease that business, and none of them would be able to continue farming the land in a self-employed structure, i.e. another partnership. But the answer in that example would be for them to start, for their FBT to be with a separate a company, which there could be directors and shareholders, and the company would take over the farming on that land.
Right.
If it was, say the land was currently owned by mum and dad, and son or daughter was only an employee of the farm business currently, so they had they weren't running the business for tax purposes, and they didn't own any of the land, then mum and dad could sell the land, cease their business, claim the business asset disposal relief, and son and or daughter could take on the FBT and carry on farming it. But yes, so the original owners must cease and either not farm it again or continue business or use a different legal entity. Yeah,
I see. Thank you. I think there was another one on. Yeah, you talked about the danger of the inheritance tax risk of not having relief if the cash goes, you know, just into a bank account. I mean, I guess that's, you know, if you've got rollover plans, that's one thing. I mean, other than cash, what would you recommend people do to protect it?
That's a good question, and there's many answers to that. I suppose if you're going to reinvest it into other businesses or other agricultural land, once you've passed the qualifying time limits, you'll have got it under agriculture or business property relief again. We would generally work with the family's lawyer, and if it was purely going to stay in investments, is it time to move it around the family, get some gifted into trust, gifted to other members to reduce the more senior generations of the family's exposure to inheritance tax?
Yeah. Okay.
But it very much depends on what their ambition for the money is.
Sure. Thank you. So I've got a one for probably Roland here and possibly Michelle as well. How does the farmer seller protect against a developer who is by that stage, I'm not sure what stage that is, a part owner, agreeing overzealous planning gain contributions or costs? Would this be arbitration or expert witness or an expert witness issue?
Okay.
I think you'll have to interpret that to some extent, because I don't know if they're talking about
the complexities of dispute resolution mechanisms that you might have in there and the circumstances in which those might apply. But I think the real point is here, you're going as far as you can in actually trying to align your interest with the purchaser. So you know, to the extent that you can agree the basis on which those development proceeds are distributed, your interests should be aligned. Whereas with a promoter, very often you can quite easily find yourself in a position, if a promoter is able to deduct all of the planning expenditure, for example, before distributing sale proceeds, they have very little incentive to you know, keep a lid on cost. You know, and you can quite quickly get to that point once you have greater certainty over the outcome. Whereas with a long-term partner like this, ultimately you're sharing in 50% of the net value. So whatever costs those are, even if they are deductible, that purchaser, then landowner, is bearing at least 50% of that cost. So yes, you can build in protections, and absolutely that is part of those agreements. But you know, the fundamental principle is that you have very strongly aligned interests in that, as I say, you know, they are sharing in that cost to the same extent as you are, principally. So I'm sure Michelle can add some more to that.
Thank you.
Yeah, I think one of the things that you would do is you would set out some objectives, which might be planning objectives, disposal objectives, to make sure you're aligned, because sometimes the objective is to get as much money as possible to maximise the receipts. Sometimes people have quite strong views about wanting to go for a quality scheme, and obviously if you go for a quality scheme and you're putting in the very highest building standards and as much open space as possible, then that's great for in one sense, but it doesn't necessarily release the most money. So there is the example people talk about, if you're selling to a sort of low-grade house builder, they just knock them out, then they may pay lots for the land, but it may not be something that if you want to continue to live in that area, it's not a legacy scheme for you. So again, you want to find somebody that you're going to work with who has the same values and the same core objectives as you do. In terms of costs, what you would sometimes see is a budget. The budget is agreed with a cap, and so that you would agree to only a certain amount without coming back and checking in. And very often there is a sort of reporting, regular meeting. So as much as you want to be involved, you are involved. I mean, planning can be very expensive. It depends, you know, what you need to do. You know, sometimes you're surprised. You have the chat with the planners and they think it's, you know, it's a fantastic opportunity and why has nobody thought of bringing it forward before now? But sometimes you have to work much harder and deal with objectors, so you can run up quite a lot of money. Maybe as local objectors you have to go to appeal, but I think it's about showing that what they can recover are the reasonable costs properly incurred, and I think that there is that's the test really in terms of what's reasonable to get that planning permission. But having sold it, it's, you know, the partner is at risk. It's not, you know, they want to spend their money wisely to get a good result. So I would say look at the objectives, agree sensible ones that you're aligned with, and try and, if you can, get something in to try and manage costs.
Thank you. So we've got another question asking what sort of share, this is the question, what sort of share can I expect to receive of the net sale receipts? So you get the vacant possession value of the land, and then at some point in the future when planning is granted or the land is sold again to develop, what's the sort of range of additional cash that comes in at that point?
So it's typically not more than 50% of the net value, but 50% is not itself untypical. So you know, we'll often see 40 or 50% of the value remaining with the original seller.
Of the value of the development sale?
The uplift value, the uplift, yeah, the net uplift in value.
Yeah, okay.
And Roland, contrast that with what you might expect to get if you had a promotion agreement or an option agreement. You might typically get 85% or 80% of the sale proceeds.
Yeah.
And just going back to Andrew on the on that issue of the current vendor no longer being able to be involved in the business effectively because the business has to cease if they want to use business asset disposal relief. could you get around that by becoming a contractor and having a long-term contract farming agreement instead of an FBT? I mean, I don't know whether legally that would be sensible, but
I'll let some of my fellow experts answer the legality, whether it works for the developer or your business partner. Good fit? No, not good fit. I think that's if landowner was farming the land himself and then took the money and tried to claim business asset disposal relief, and he was still contract farming it or acting as a contractor, I think
it's too close to the close to the line.
Have ceased your farming trade and activity at the same time as selling the land. The common sense answer to that is no, and you would fail on your business asset disposal relief claim. Yeah.
Okay. I think Roland, I think it was you that mentioned contract farming in your presentation. So I just wondered how that had been.
I think typically, although we run several contract farming agreements for a number of different institutional landowners, that's normally in fairly particular circumstances. Institutions very often would prefer to take a rental income and have limited involvement in the day-to-day operation and trading risk associated with an agricultural enterprise. A contract farming agreement will typically be more attractive to a private purchaser who may be looking to buy that land as an inheritance tax shelter, for example. So, as I say, if there is a seller, I sort of mentioned it in the context of a potential sale where somebody wants to pursue this sort of arrangement, but does so possibly in the open market where they're offering the freehold for sale, but reserving the right to carry on contract farming under predefined terms, for a defined period of time. So it is less relevant to these sort of circumstances where there are very long-term agreements with institutional purchasers.
Yeah. Okay. Thank you. And we've got a question about renewable project land. The question is, renewable project land development, is this actually viable now? And I'm not sure whether they're asking whether renewable energy is a viable proposition, or whether in terms of sale and leaseback, would that inhibit, would it inhibit a purchase if there was a big solar installation on the farm? I guess that would be a third-party interest, so it might complicate things.
So, I mean, just in terms of sort of viability point, I mean, renewables as a concept are obviously, very much viable. We're seeing, renewable developments taking place all over the country. The constraint very often is availability of adequate grid capacity. So it's not typically, planning constraint, but actually, as I say, availability of grid capacity. We don't usually see sale and leasebacks pursued for the purposes of renewable development. That's not to say it couldn't happen, but as I say, either there will. It's fairly binary as to whether there is an opportunity and the availability of adequate grid capacity. And if there is, it's probably a much shorter term proposition, and therefore there would be an alternative structure which would be more attractive and more lucrative for a landowner. A long-term agreement with a and as I say, in the leaseback context, if you're sticking solar all over it immediately, they're not going to be farming it anyway. So
okay, thank you. And just occurred to me that we've got a lot of changes happening in land, in terms of policy, support, structures, and how land is held over the next, 10, 20 years. What would happen if during the period of the tenancy after a sale and leaseback, the land acquires some sort of designation where planning becomes far less likely because, I don't know, of some environmental designation or other thing that's happening? I mean, do the agreements cater for that, Michelle?
I think what would probably happen is that if it became evident that planning permission was unlikely to come forward, I think sometimes if you think about it in terms of local plans, they sort of come round every sort of 5 years or so. And if it's just that it's not ready, but it's still possible, then you would probably wait it out. If something happens so that the land was designated I don't know, area of outstanding natural beauty or something which meant that it was really never going to come forward, then it may be that at that point the institution decided that they would sell on the agricultural land. They might keep it, because quite a lot of these institutions do hold valuable agricultural land.
Yeah.
Still want to be in a position whereby this agreement would continue. Nevertheless, you might have the chance to buy it back, but it's still the point that if planning permission happened to be obtained, I mean, Roland said some of these agreements run for 80 years. So it's possible that it could be redesignated well in the future. So as a landowner, you would be protected in the long term. So if institution on day, the first institution thinks I've had enough, it's not for me, and they sell it on to somebody else, it would be subject, they still take on those obligations.
Yeah. But there's no guarantee then that planning will be achieved.
No.
So I guess, pulling the potential planning gain, part of that back into the purchase price for the landowner is probably desirable.
Well, it would still roll forward. So I think the point about these agreements is on day one, there is no guarantee that planning permission will ever be obtained. And I think we're saying that they're more likely to be for the medium long term. So I think you have to be patient, but it does mean that, very often you wouldn't say in such a long-term arrangement that the institution has to promote it every day really hard all the way through. It's about usually as recommended by planning consultants, because there may be periods of activity and then nothing because there's nothing to do, you're waiting. But it still does mean that it's not like the deferred consideration, it's definitely coming. With this, it will only come if you get planning permission.
Okay, thank you.
It's also, the institutional investor is taking on the planning.
Could you do very quickly, please, Roland, because I think we've got to wrap up in a minute.
Sorry, the purpose is obviously the institutional investor is taking on that planning risk. So, all of these things will be, based on the binary outcome of a planning process. So there is absolutely no guarantee that it will come.
Okay.
Hence why they can do that as part of a wider portfolio.
Yeah. Okay. Thank you. So I think we're almost out of time. Just wanted to say thank you very much to all the panel. I think given people plenty of advice, and we've covered a lot of ground in this webinar. So I hope it's been useful for the people who registered and watched. You can watch again. As I said earlier, you'll get an email to let you know when the recording's ready. And thanks very, very much to all three of the panel.